Good evening and welcome. My name's Murray Harris. I'm Head of KiwiSaver and Retail at Milford, and it's my great pleasure to welcome you into another of our broadcast events. Whether you're a member of our KiwiSaver plan, an investor in our investment funds, or in our wealth management service, thank you for joining us. I'm sure you're familiar with the format for these broadcast events from prior events, but this evening we're going to take a slight change of tack, so I apologise, it's not as advertised on the tin as a KiwiSaver and Investment Fund Q&A. We will get to a few of your viewer questions, and thank you for sending those in, but we wanted to spend more time this evening discussing the events in markets over the past week or so, and I'm sure you'll be very pleased to hear that. So I'll be spending more time this evening discussing the events of markets with Stephanie Batchelor, one of our investment team, but I'm also joined by a couple of our KiwiSaver advisors to answer some of your viewer questions. That should take about 45 minutes and our team will be available post the broadcast as well to continue to answer your questions on the online portal. So you might be asking, how do I ask a question? On the screen in which you're viewing the broadcast this evening, you can see to the right a question and answer box. You can simply type your question in there and that'll come through. Now, we've had a lot of questions already, as you can imagine, and we probably won't get your question if you ask it this evening onto the broadcast, but we'll certainly respond to you via the online chat. And if you leave us your email address, we can also respond via email in case we can't get to all the questions through the online chat. Now we will be, as I said, continuing to answer questions with some of the KiwiSaver and Investor Services team post the broadcast through until 8:15 this evening. So if you do send in a question and you want to see your response, you'll need to stay on the portal until 8:15 or until you see the response to your question. But like I say, if you leave your email address, we can respond to you that way as well. And you might want to do that because actually we'll be choosing 10 questions from the online portal to win a pair of very stylish Milford business socks. I don't know if you can see those, but I'm modelling those. They're very, very comfortable. So leave your details if you do want a direct response. Now, of course, you can send us a question at any time. We understand that volatility in markets can be disconcerting and unnerving for investors. You can contact us at any time via info@milfordasset.com or contact your usual advisor or contact person at Milford. We also have, as a resource for investors via our website, The Investing Place. That's www.theinvestingplace.co.nz, and that has a wealth of information for investors to help you through your investing journey. And we post there articles, stories, videos, podcasts, and our Bridge Talks business weekly video interviews with Ryan Bridge. So go there, a wealth of information to help you on your journey. Now, just a reminder that this evening's presentation is does not constitute financial advice. It is intended as information only. Should you need financial advice, you should consult a financial advisor, whether that be your usual Milford advisor, an advisor independent of Milford, or one of our team. Their advisor disclosure statements are available upon request and free of charge. So before we get into the question session, just a brief update on fund performance. And you can see here a brief snapshot of the Milford KiwiSaver funds. Now I do point out these returns are to 31 March, so they don't include the drawdown and the fall in markets over the past week. And these returns are all after fees and before tax. And as you can see, a range of returns over the past year. But what you can see is that the more conservative funds have performed slightly better than the growth and aggressive fund. And that just reflects the volatility and the volatile markets we've seen over the past year, where short-term returns have been impacted by those funds more exposed to share markets. But over the longer term, those 5 and 10-year returns are more return profile that you'd expect to see there, with better returns from the growth and aggressive funds, and also very pleasing to say that the Milford KiwiSaver Active Growth, Balanced and Conservative funds remain the number one performing funds in their categories in the Morningstar survey to the end of December. And a snapshot of some of our investment funds there as well. That's not all of our funds, but just a snapshot of some of the more popular ones. And again, you can see a return profile over the past 12 months where the conservative funds have outperformed some of the more aggressive funds. A shout out to the Diversified Income Fund at 8.14%, benefiting from returns in fixed income and other income generating assets, which is very pleasing to see, and a more traditional return profile over 5 and 10 years. So let's introduce our panel for this evening. I'm joined on the Milford couch by Stephanie Batchelor, who's a senior investment analyst in our investment team with a particular focus on global shares, which is very pertinent at the moment. Liam Robertson, a senior financial advisor in our KiwiSaver team, and Kirsten Bennett, also a KiwiSaver financial advisor at Milford. Welcome. Thank you for joining me. So, Steph, starting with you, it's been quite a week on global share markets. Let's just take a step back in case anyone hasn't been watching the news or following closely. Can you explain to viewers exactly what's happened and why?
Yeah, so the market reaction to Trump's tariff announcement last week was swift and severe. The tariffs came in much worse than the market was expecting. And if you think back to his first term where, the tariffs were focused primarily on China, these ones are much more broad-based. And so the concern is the impact that these tariffs will have on economic growth, namely slowing growth and higher inflation, as companies pass on the cost of these tariffs to US consumers through higher prices. And that inflationary pressure also potentially takes tax cuts off the table.
So because the market was taken a bit by surprise, and the quantum and breadth of the tariffs that we've seen, because of those being greater than we expected, we've seen some quite remarkable moves in share market indices, in particular the US. So relative to prior market falls, how does this one compare?
Yeah, so since the tariffs were announced last week, the US share market, or the S&P 500, is down about 11%. And if you look back to sort of mid-Feb, when this broader pullback started, the US market is down about 17%. And look, this isn't actually unusual. So corrections of 15% or more take place on average every 2 years, and corrections of 20% or more take place on average every 3 to 4 years. But it is quite difficult to compare this one to past pullbacks because each one has quite a unique set of circumstances. If we think about the GFC, that was a banking crisis that was caused by a build-up of excess. It was a slow, protracted fall down and a slow recovery. If we think of COVID, that was a very sharp, severe drawdown and then quite a sharp recovery as well because government stepped in. There was a lot of support and policy support. If we think about this situation, it's been a sharp sell-off in response to a policy decision. But the economy is coming from a place of strength, and as quickly as these tariffs were put on, they could be reduced or removed. So, it's really in the hands of Trump, and it's quite a different scenario from COVID and the GFC.
So markets always are reacting to events that cause them uncertainty. Each one's unique. I remember in the pandemic, people were saying, well, we've never seen this in our lifetimes, and market reacted, and of course subsequently we recovered very strongly. This will be no different, I'm presuming. So what you're saying is that market pullbacks of this magnitude are very normal. They're a very normal part of the investing cycle, and they happen reasonably regularly. And over the past 2 years, we've seen a lot of money flow into the US share market in particular on the back of that very strong performance and recovery post-2022. So how does investor positioning and sort of crowding impact these sell-offs?
Yeah, so over 2023 and 2024, the US economy was strong. We had moderating inflation and we had very supportive policy. So as a result, US markets steadily went up. Investors benefited from that, and they expected that dynamic to continue. So as a result, they were all positioned the same way. They had too much in shares, too much in the US, too much in growth stocks. And now we've had this tariff announcement, which is a negative catalyst. So it's sort of jolted investors out of that rosier picture, and it's forced people to come to terms with the fact that we've come from very supportive policy to now very negative policy, and to think about how that's going to impact economic growth. So we've had prices and valuations reset lower, which is more sort of building in the current reality, and that does make it a more interesting investing environment for us as active managers.
Yeah, I want to pick up on that point because, us being active managers, we had been flagging our concerns around the elevated company valuations for some time. So how were we positioned going into this pullback in light of the fact that, we had those concerns anyway?
Yeah, so last year we began pivoting the funds away from the US and towards regions like the UK and Europe, where we felt valuations were a bit more reasonable and there was a bit more of a balanced risk reward. We also, from a stock perspective, began shifting a little bit more defensively, so allocating more to sectors like utilities and consumer staples. Some examples there are Contact Energy, SSE, Coca-Cola Euro-Pacific Partners, and sort of away from some of the growthier areas of the market like technology stocks. And now it's not because we had a crystal ball, we didn't know that this was going to happen, but a fundamental part of our process is evaluating risk and reward. And so naturally that kind of pushed us towards those areas, and that's done well for us. So since that mid-Feb pullback began, the UK has been one of the better performing regions.
So as an active manager, we've been able to position more to the UK, for example, more to defensive stocks, less exposure to the Mag 7, for example, and those very highly priced technology companies. So that's one of the benefits of the many levers that we can pull as an active manager, as opposed to an index fund which will just follow the market up and down, of course. So as an active manager, we can tilt away from countries and companies we think are overvalued or more risky, and we've certainly done that, to those better value countries, regions or companies. So can you talk to some of the specific fund performance during this pullback as a result of our positioning going into it?
Yeah, and there are obviously some very scary headlines out there around this market pullback, but it's really important to keep in mind that Milford's funds are not the market. Our diversified funds are made up of cash, bonds and stocks, and because we're active managers, we're constantly evaluating the risks and we're allocating clients' money towards the areas that we see are attractive investment opportunities. So our funds will differ from the market in terms of the allocation to asset classes, geographies, sectors and companies. So just to bring this to life, since the mid-Feb pullback, global share markets, so you can use the MSCI World Index, it's down about 13% in New Zealand dollars. Our active growth fund is down less than half of that, down 5%. And actually, if you look at the more kind of conservative end of our funds, the diversified income fund is actually up 1%. So, of course, we don't want any of our funds to be down, but it does highlight that in this kind of environment, this sort of scenario, we are able to cushion some of that downside.
So that's a good point. So our active fund positioning and risk management has cushioned some of that market fall for our clients, which is great to hear. We can't cushion all of it. Obviously, we don't get positive returns when markets are this negative. But you make a very good point about the distinction between our funds being well diversified and that they're not the market. So people shouldn't panic to the headlines. So as active managers, these sorts of pullbacks do provide us with opportunities, right?
Yeah, and that's the really exciting part of being an active manager. So not only can we manage risk and protect or cushion some of that downside, we now get the opportunity to buy some of those really high quality, fantastic companies at much more attractive levels. And so it's a bit of a double benefit. Our funds don't fall as far as the market, but we still get to swoop in and take advantage of those fantastic buying opportunities.
It's like the Boxing Day sales, isn't it? And it's the psyche of investors is that when markets are falling, people panic a little bit. They want to sell. But if there's a Boxing Day sale at 25% off TVs or microwaves or whatever, people rush to the doors and buy. So that's the interesting thing of investor psyche. So just tell us, what have the team been doing in the funds over the last few days as a result of all of this?
Yeah, so we've been really active. Things are now more reflective of reality, so we can increase our exposure a little bit. And in terms of what stocks we've been looking both on the defensive side at names that have fallen further than they should, so areas like utilities and consumer staples, but also on the more cyclical, growthier side, where valuations are now baking in some pretty negative scenarios for a long period of time. So look, we're not bullish, but we don't need to be quite as defensive as we have been, given that we've had this correction.
So another benefit of our active investment style, right, is that we're able to go in there and pick companies that we see as being good value, rather than having to just hold the whole index.
Exactly.
Yeah. Well, thanks, Steph. That's very helpful. Some really good insights there. I've got more questions for you, so I will come back to you soon. But I just want to bring in some of our viewer questions now and head to Liam and Kirsten. Starting with you, Liam, on that point of market pullbacks and good buying opportunities, if you like, for investors. We have had a question where, several questions actually asking about the buying opportunity and the pullback in markets. One of our viewers has sent in a question asking that if I have some money to invest, am I better to wait until the market settles or invest now and hope that the market doesn't drop further? What would you say to them?
Yeah, $1 million question. It's really, really difficult to time the market, right? And we really don't know what the top or bottom of a market is until we have the benefit of hindsight. But what we can say at the moment is if you did invest some money, if you're thinking about doing it, you're really banking the discount that's already been offered by the market because it has fallen from its peak. Will you be buying at the bottom? Maybe, maybe not. Maybe markets will fall further, and that can be unsettling, but you are banking a discount. You're not buying at the peak. And if I use maybe an example that's dear to Kiwi's hearts, property. If you think about a house that maybe was worth $1 million and then perhaps the property market went through a bit of a fall, as we've seen post-COVID, maybe you managed to buy that house for $900,000 and you'd be thinking, you'd be pretty happy with yourself. You've saved $100,000. If the house fell a little bit further, maybe to $850,000, you'd think, geez, I've lost $50,000. But actually, you'd probably console yourself and think, hey, at least I didn't buy at the peak. I didn't pay $1 million. I only paid $900,000. It's much the same with investing in funds, be they KiwiSaver or investment funds. There are discounts available at the moment.
And we know nobody can pick the bottom and nobody can pick the top. So if you've got money to invest, you invest it when you think it's the right time, and this could be a good opportunity. Yeah. So, and another follow-up question, we've had a lot of questions from KiwiSaver members asking whether they should switch to a lower risk fund and to wait this period of volatility out, and then switch back perhaps to the growth fund or aggressive fund. What would you say to anyone thinking of switching to a lower risk fund to sort of shelter from the storm?
Yeah, look, I'd say that provided as an investor you're in a fund that's aligned with your goal, your time frame and your risk tolerance, then market volatility is not a reason to make a change in your investment strategy or to change to a lower risk fund. So for the majority of people, I think they can stay calm, stay the course. I actually looked back at COVID as an example, and the FMA released a really good report in 2021, and they looked at investor behaviour throughout COVID, and they found that in March 2020, as the market bottomed out, switching activity was 7% higher than usual, and 70% of those switches were to lower risk funds. All in all, $1.2 billion was moved from higher risk to lower risk funds. And then unfortunately, only $121 million made its way back to the higher risk funds, which meant that $1 billion or more missed out on the subsequent recovery. I mean, how big was that recovery? Well, from the bottom of the market, which was actually about 5 years to the day, to now, the S&P 500 is up about 100%. So some of those investors, maybe they needed to move to a low risk fund, maybe they needed the money, but for the vast majority of them, they probably didn't need to do anything.
And if they haven't moved, they've missed out on those returns. I was reading some research recently from Morningstar around the same period. Investors who switched during COVID to a lower risk fund and then tried to time the market got a 2% worse return at the end of the year than those who just stayed the course. So again, I think it's proof that nobody can pick the bottom or the top of markets, and if you're in the right fund, you stay the course. Great, thanks Liam. Now, Kirsten, to you, so this volatility may be prompting some KiwiSaver investors who are already retired or closer to retirement to rethink their strategy. And we've had a viewer ask, is my KiwiSaver account a suitable place to keep all my money after retirement, or should I take some or all of it out and invest elsewhere? How would you respond to that?
Look, Liam's already mentioned time in the market. Consider the investment time horizon in which you've got plan to use your funds. Also the risk that you're prepared to take. So look, if you're planning on using those funds, maybe drawing an income from them over the next 10, 20 years, you've got a longer time frame. So maybe in a KiwiSaver or investment type fund may be a good option for you. But considering if you're planning on spending that money a little bit quicker, maybe over the next 5 years, maybe a lower risk fund option could be, or a lower risk option, investment option could be for you. So considering all your factors, seeking some guidance, seeking some advice before you're making some moves.
And advice is important, right?
Very.
And easily accessible.
Very easy, yes.
Yep. And a follow-on from that, a member approaching retirement has asked, if I'm late to the KiwiSaver party and retirement age is within 10 years, which is the best fund type for me?
Look, again, a very good question. If your retirement time frame is in with that 10 years, you have maybe considering a shorter to medium time frame, meaning that you might be more thinking of preserving your funds, but also thinking of growing your funds. So some strategies to think about is looking at fund choice based on that investment time horizon, but also if you were in a financial position, maybe considering what contributions you are making. It could also grow those savings over this time.
Thank you. So, time frame of your investment horizon it's a really important consideration, right? Because the longer the time frame you have, the more risk you can take, because you have time on your side to recover from any market pullback. So, Steph, coming back to you, we've had some questions from clients around when we think this recovery might happen. What are we looking for to indicate that the worst is behind us, or will we ever know?
Yeah, well, as you've just discussed, markets are almost impossible to time perfectly, and there is still a lot of uncertainty out there. There's potential sector level tariffs, there's the retaliation that we see from other countries, and China was the first to retaliate over the weekend, and there's a risk of further escalation. But there are also a couple of things that could turn this around. I've said before, this pullback has been policy induced and effectively self-inflicted by the US. So Trump could turn things around, either through de-escalation. So we've seen a lot of countries come to the negotiation table and try to have discussions to either lower or remove their tariffs, or policy could come on the other side, so things like tax cuts or deregulation. Obviously, trying to predict Trump's next move is very difficult because he's inherently unpredictable. So it's quite hard to say exactly when the bottom will be or how long the recovery will take. But even though we have this high level of uncertainty, we now have prices that reflect that high level of uncertainty. So for us, that makes it a more interesting investing environment.
Yeah, great, thank you. So what I'm hearing is that nobody knows exactly where the bottom of the market is. We could see more volatility to come over the next days, weeks, or even months. So Liam, bringing this back to you, volatility can obviously be worrying for investors, but for KiwiSaver members, it can actually work in their favour, right? In a strange sort of way, due to what we call in the trade dollar cost averaging. So the next couple of questions actually align well with that. We've had a couple of people ask similar questions. If you're making monthly voluntary contributions to your KiwiSaver, would you keep doing it while current volatility is around, or wait for markets to recover? And another similar question, because of the current markets, should I reduce the amount I'm putting into my KiwiSaver regularly? What would you say to those viewers?
Yeah, dollar cost averaging is the silver lining of periods of volatility like this. And it's the concept of contributing a fixed amount at a regular interval into your investment, no matter what the market's doing. And what you're trying to do is smooth out any price fluctuations over the lifetime of the investment. And KiwiSaver works like this by default because you pay in every time you get paid by your employer. What that means is that you're paying in, and if the price of the market lowers, then you're going to get more units from the same fixed contribution. And if markets are doing really well and they're rising, you're actually going to get fewer units for the same contribution. So by definition, at the moment, if you're paying in and markets are down, you're getting a sale. You're getting more units for the same contribution. So I would say to that person, if you're in the financial position to carry on with those contributions, do so. It's the best time to contribute that we've seen for the last year or couple of years.
And it's one of the key benefits of KiwiSaver. Those regular contributions just keep going in. You don't have to even think about making that contribution, and you benefit from the ups and downs. So,
That's right.
Yeah. So just sticking with some of the other viewer questions that we've had in, Kirsten, one for you. Which is better, a KiwiSaver or an investment fund?
Two really good options. They both have a place, and they also have differences. So considering maybe the KiwiSaver option, it's a more disciplined savings scheme, government contributions, employer contributions, but being very mindful, not very accessible to access your money if you need to, where you can usually only access your money for retirement, first home, maybe under some circumstances, under severe financial hardship, subject to approval, or permanent immigration. But when we're looking at that investment fund, it's the fund that has no type of investment that has no locked-in period. A little bit more accessible. You can make contributions whenever you like, but just being very mindful. You need to be a little bit more disciplined with this type of investment. Setting a goal, obviously, is important. So you do have the opportunity to dump deep into that investment fund prior to reaching that goal. So you do need to be disciplined. So if you're looking for a longer-term investment disciplined savings scheme, KiwiSaver is a really good option. But when you're looking at something, if you're going to need access, easy accessibility, more flexibility with an investment product, well, obviously an investment fund is an option. But just one thing, if you don't mind me adding, is that considering that these are types of investments that you can have both. Now, we have clients that have both of these types of investments running alongside each other, getting the benefits of both at the same time.
Yeah, that's a good point. So some more accessible money alongside your KiwiSaver. So you've got your savings for your retirement locked in. You can't touch that, only under special circumstances, but some other savings that are there working harder than a bank deposit that you can access. Yeah.
Correct.
And then when you turn 65, you can stay in your KiwiSaver fund. There's really no difference between that and the investment fund, right?
There is no difference, absolutely. It just, you can access either one of those when you need them, apart from putting your card on the wall and accessing it that way.
Yeah, of course. And another question on splitting between two KiwiSaver funds. So this viewer has said, can I split my KiwiSaver fund into two funds, one growth and maybe a smaller fund aggressive? Can I direct future contributions to just the aggressive fund?
Absolutely. So, look, answering that question in two ways, because it's two parts of the question, is that you can split those funds. Very accessible doing that via your online portal or through our app. But look, I would suggest that having a conversation, talking through your strategy before you jump into making that decision. If you did want to if you did go with that strategy and want to direct your contributions in one direction rather than the other, you need to give us a call or contact us because we'll need to execute that request for you.
So yeah, advice is easily accessible. Just maybe explain how viewers can get KiwiSaver advice from Milford.
Easy. 0800 number, give the team a call. The other option is jumping onto that desktop, putting in your request, and one of us from the team or one of our other colleagues, Shinil Mataza, will reach out to you, make a time, have a conversation and take you through what that process involves.
And if talking to a person's a bit scary, you can do it online?
You can do that online as well. We do have a digital tool that you can get some bot advice, or as I said, if it's a bit scary talking to one of us, you do have that option as well. You can, couple of options.
Yeah, and all at no charge.
Absolutely. It's a fee-free service that we do offer our clients or any prospective clients that are looking at coming in as well.
and particularly times like now, it's amazing how often people think they've got one risk profile, and they find they're actually
Correct.
something quite different when markets do get a little bit jumpy. So, I'd encourage you to reach out to the team if you're unsure, and we can help you with some KiwiSaver advice. We've got one other viewer question here, which I think is probably relevant for you, Liam. What are the benefits of investing in a managed fund versus just investing in the share market directly?
There's a few benefits that spring to mind. I suppose one is time. A lot of us don't have the time, or perhaps, if I'm honest, even the desire to spend the amount of time needed to actually analyse whether a particular share, bond, commodity or otherwise is suitable for investment. And perhaps we don't have the expertise either. We've got Stephanie alongside 40 other investment analysts in the team here in Auckland and in Sydney who spend all day, every day doing that work for us, for both Milford staff who are clients as well as clients as well. And I think it's like anything in life, we outsource to professionals, right? You go to the hairdresser to get your hair cut, you get tradesmen in to work around the house, or my wife wishes I did that. I'm not the best at DIY. So managing your money is just the same. Outsourcing to a professional has its benefits. It's also a really easy way to get diversification. One investment into a fund spreads your money across dozens and dozens of different securities, as Stephanie mentioned, in different geographies and industries as well. And then there can also be some tax benefits, because KiwiSaver and investment funds are what we call PI funds, which have a top tax rate of 28%, versus what can be up to a 39% tax for directly held investments as well.
So some clear benefits there of a one-stop shop managed fund investment. And as Stephanie's alluded to, there's an awful lot of resource and investment thought and thinking that goes into how we're positioning those funds, so versus picking a few stocks yourself. So, yeah. Look, we're almost out of time. It's been incredible how quickly this has gone, actually. We could probably go for longer. But, Steph, back to you for the last word. Look, I think you've articulated very well how we were thinking going into this uncertainty, how we've positioned away from some of the risks that were on the horizon, and how our active investment approach has served clients well with cushioning some of that downturn, which is great to hear. So I guess the big question is, what's our outlook on going forward? Where to from here? Yeah,
well, look, headlines are going to continue to drive a lot of the market moves, and we do expect to see big swings both down and up. So it could be a bit choppy for a while, but given expectations have now reset lower, it becomes harder to surprise people more negatively when they're already sort of expecting the worst. So look, we're still positioned overall defensively, and we do continue to expect that volatility up and down, but we're going to stay flexible, and we're actively looking for buying opportunities.
And again, as an active manager, we can pick and choose the investments we want to have, how we position ourselves, and how we navigate for our clients. Very good. Thank you very much, Steph, and thank you, Liam and Kirsten. We haven't had as many, or been able to get to as many questions from viewers as we would normally, but thank you very much. I hope that's been helpful for viewers. So unfortunately, we need to wrap it up there. Thank you very much for tuning in. These really are interesting times. I hope you've enjoyed watching the update this evening, and as I said, acknowledge that we didn't get to as many of the viewer questions as we would normally, but we thought it was important to bring you an update on markets, how we've been positioned and what we're thinking going forward. Great to hear that our positioning has cushioned some of that blow for investors. There will be more volatility as we move forward, but we're doing our very best to manage that. And as Stephanie has said, we've got a very skilled team that's thinking about this day and night, actually, I think, so particularly at the moment. So I hope that's been able to calm any nervousness that you might have been feeling, and has answered some of your questions. We feel those nerves as well, because as you know, at Milford, we all invest in the same funds alongside you. So, we know exactly how you feel. If you've missed some of tonight's broadcast, or you've got family or friends you think might benefit from viewing it, we will make it available on the investingplace.co.nz. probably tomorrow, so you can go there and re-watch it or send it to family and friends. As I said, lots of other interesting information, podcast videos, articles there to help you on your investing journey. We'll continue to bring you more of these events, so look out for the invites for those in your inbox. Just a reminder on the questions, if you have a question at any time, you don't need to wait for one of these updates, just drop us an email, info@milfordasset.com, and our team will respond, or speak to your usual advisor or Milford contact person. We are here to help you. As I said with the Q&A on the portal, if you've left us your email address, we will respond to you via that if you have a particular question, or if you've got a question you've put into the portal, the team's there till 8:15, wait for your response there, or continue to communicate with them. As I said, we've also got some Milford socks to give away. We'll be choosing 10 lucky winners from the questions. There's a short survey as well, so we'd like your feedback on this evening's event and feedback on future events. It's a little 2-minute survey. It's on the portal. You'll see the box there to click in. If you complete that, we'll also choose 10 lucky winners to win some Milford business socks, so leave us your email address so we can get in touch with you. So I'll just end by saying thank you very much for joining us. To summarise and some investing points or some tips and tricks for investors, most importantly, don't panic. Your investment balances will continue to move up and down as markets continue to move up and down in the future. All investing involves risk, and markets go up and down through normal investing cycles. 2025 will continue to be challenging, but as an active manager, we're able to manage risk and whilst looking for new opportunities to invest in. It's important to have an investment goal and know your risk profile. That will enable you to stay the course through market ups and downs. Investing is a long-term game. Those who remain committed to their goal and stay the course are rewarded over time. If you aren't sure or you are worried, reach out and seek some advice, either from your normal Milford advisor, one of our team, or your advisor independent of Milford. We are here to help. And finally, I'd like to thank you for entrusting your funds with Milford. We're a staff-owned business who invest alongside you. As I said, we feel what you feel when markets are volatile. We really do appreciate your business and investing with Milford. Thank you for tuning in, and good night.